Young Gooners, today I'm going to teach you how to trade. Finally, I'm going to make a trading tutorial. I'm going to teach you some free strategies on how to actually fucking make money. Okay, these are proven systems. Simple shit with no fairy tale bullshit. I'm going to start with really simple strategies, then I'm going to dive into the really complex, fucking blow your mind type of shit. But I won't go into crazy depth with that. I'm just going to lead you in the correct direction so that you know what to look at. So, the first thing that we're going to be looking at is a strategy that I sort of developed on my own. It all started with something called a buy stop. So, a buy stop is a particular type of order, okay? Or it didn't start with the buy stop alone, it's a stop order because it goes both directions. So, when it comes to a stop order, basically, a stop order is an order where, unlike a buy limit, okay, you have the traditional buy limit where your buy limit is there, price goes down, it goes in, it activates your buy limit, it goes back up, you make money. When it comes to a buy stop, okay, if we have a buy stop, now when it comes to a buy stop, unlike a buy limit, with a buy stop, what's going to happen is that price is going to come down, and the moment it gets to the current price, it's going to buy. You understand? Buy limits. So for the buy limit, if you want to buy, you have to have the price above. You have to have your order below the current price. For a buy stop, it's basically the inverse. The price has to be below where you want to buy. So the price is rising. The moment it touches your buy stop, it's gonna buy. And when it continues in that direction, you start making money. So the stop order, you make money in the same direction. So market was going up, it hits your stop order, you make money. Okay, that's a buy stop. Buy limit, there's to go in and out. Sell limit, there's to go in and out. And your stop loss is there, that's when you get wigged out. Okay, so we're gonna use this type of volatility to our advantage. This is gonna be volatility based trading. You won't need to know the direction of the market. You just need to know when the market is volatile. In fact, you don't even need to know that. That's just a plus, but without even knowing that, you can still make money from this. I have a system that makes money from this, but this system will make money in specific instances with a near 100% win rate. The only thing that can make you lose money from this particular system I'm about to explain is slippage. If your broker is fucked, but if your broker is solid, you make money almost all the time. So basically, with the buy stop and the sell stop, what you're gonna do is we are at news, okay? When there's news, people are gonna start removing their orders from the order book because they're scared. So what's gonna happen is that there's gonna be increased distance between orders. It's going to be increased distance between orders in terms of the big orders. So someone's going to have a massive sell order there. Someone's going to have a massive buy order. Seems to be on the other side of the order book. Someone has a massive sell order there. Someone has a massive buy order there. So what's going to happen is that if this guy sells there, let's say the market is moving there, the market is moving there, okay? And then news starts, and then that guy sells, his order is going to be matched to that guy. So since there's not enough liquidity at all these levels, okay, there's tiny liquidity, or some of you guys that are kind of stupid enough to try and forecast what's going to be announced in the news, you guys are still going to be there, but your liquidity is going to be ignored because of these two massive players. So what's going to happen is that the moment this guy fucking sells during that news event, okay, when he sells and there's no one to take his liquidity gently, the market will suddenly jump to this guy over there. So it's going to have this sharp move. And then this guy, he buys, okay, so he's there. Then another nigga also buys. Then it's going to basically shoot back up there. You understand? So when this happens, that's when you have these crazy moves. You get big dot market goes back to where it was. Basically, you can make money from this, okay? If you have a buy stop there, and you have a sell stop there and a buy stop there, okay? Buy stop, sell stop. Market is flowing, news is about to happen. You put a buy stop and a sell stop as close as possible to the market. Then you put your take profit as close as possible as well, okay? And then you really risk, okay, you increase your risk because basically what you're gonna have here, your stop loss, you're gonna put it as tight as possible. The minimum that your broker will allow you to put as your stop loss, okay, that will be your stop loss. So basically, whenever market just shoots down, it's gonna take you in and put you into profit and instantly hit TP. Another option is to leave it open. It runs straight. You put the stop loss there, then you start trailing it, start trailing it, start trailing it. You can use a trailing EMA, an EMA trailing stop loss. That can work fine. Or an ATR stop loss, but EMA is better if you want to survive the recovery. So that's one way of doing it. If it goes up, you still make money. No risk in either direction. If it goes in both directions, if your TP is actually a decent TP rather than trying to go for 1:30, you don't even know how much velocity is going to be behind that move. Basically, what's going to happen, Alpha, good day. Hey. So basically, if you don't know the velocity and you try to put your take profit there, you're going to be fucked. It's going to go there, go back. You understand? So you need to keep your take profits tight. Take profit tight, lot size high as it can go, because the risk there is very minimal. So usually, let's say that you're trading on a $500 account and you're putting your stop losses at $20 or at $50 for some of you, or maybe $100 for some of you who wanna risk high. Basically, your stop loss there could be $10, $5. If you have a $20 account, this could be $1, okay? Because it's extremely tight. So this is very small. So you can just keep increasing the lot size up until you're okay with losing that amount of money. Basically, you just need to ensure that the spread, okay? Also, your broker needs to have a low spread for this to work. But it doesn't have to be insanely low, it just has to be a decent spread. If your spread isn't that big and your account can handle it. For example, let's say that you've got a $20 account, and then your broker gives you so much leverage that your spread can be $18. Okay? With a spread where it's $18 on that lot, you might survive. You might, because the stop loss could be $2. But if your spread somehow, well, there's actually a broker that let me do this. I wasn't really aware of it. But basically, they let my spread. I tried to open the biggest position possible just to instantly go into profit. This is back when I was experimenting to see the limits of the broker. Basically, they allowed my spread to be 1970. So a micro tick to then go in my direction took me out. So you need to be wary about this if your broker will let you do that. Most brokers won't let you do this. They'll probably stop at 90% max. So probably this won't be that bad. You just scale the numbers, you just add zeros for that. But basically, that's how you trade with buy stops. Basically, before every news event, right before the news drops, you put a buy stop and a sell stop. Then you make money almost all of the time. That's the first strategy, extremely simple. Now, you can iterate on this strategy however way you want. FYI, it makes money even outside of news events. I've got a profitable strategy that uses this strategy trading the whole fucking day. So every single micro movement, I'm making fucking money. Every single movement, which is just slightly beyond what is normal, I make money off that. So you can keep exploring the buy stop and the stop order, specifically the stop order. There's profitability to be found there. Experiment with strategies like that. So this strategy falls under the random, in fact, not the random category, but the arbitrage. I think it deserves to fall into the category of arbitrage systems, okay? But basically, so this fits into the arbitrage category or the non-predictive category. These two are not the same, by the way. However, there is an overlap for this particular strategy. It's just that I have multiple groups of strategies that I explore. Right now, my most profitable strategies are non-predictive strategies, and they tend to also be arbitrage systems. So let me just finish this off. Arbitrage systems. This is what we're going to be looking at next, which is a lot more fucking complex. So I'm going to start with something simple. That strategy I showed you was a non-predictive strategy. It doesn't rely on you predicting what the market does. Another strategy, which could be also non-predictive, you could also use it in a predictive capacity or a non-predictive capacity. It depends how you want to use it. I prefer to use it non-predictively with statistics. I use statistical arbitrage in some of my strategies. That will be a little bit more complex to explain, but I will explain. So for the non-predictive category, the next thing that we're gonna have is the martingale strategy. This is an extremely dangerous strategy which can make you a lot of fucking money at the same time. So what is the martingale strategy? Basically, this is the principle. So you have this size bit. So let's say the first trade, this is the market. The market is going down. You decide to buy there, thinking it's going to go there, right? And your stop loss is there, your take profit is there. Let's just put it like that. Basically, the market fucks you. You get did. There's one loss of one lot. What you're gonna do is that you buy again. This one is a simple grid martingale system. Okay. Okay, let me just explain it as a martingale, then I'm going to go into the grid martingale. So the next thing that you do, you lost that trade, you still believe in your buy position, you buy again. Okay, you buy two lots this time. You double the lot size or the bid size every single trade. The market goes, you get did it again. So what do? You open another trade and you double the lot size again. So this time it's actually gonna be 4. Market comes down, you hit take profit. You're gonna recover both these 3 lots plus 1 extra lot. So you're gonna make 1 lot profit. As long as you can keep trading, you will keep making fucking money. Okay, it is inevitable for you to make money. You may have a losing streak, but eventually you will make money. With this particular strategy, you have 2 options to make it work. Okay, you have got a low lot base. Okay, so the base for your lot size has to be low, or you need to have extremely high capital. This is a lot easier. Okay, so for the low lot base, to make it work, you need a high frequency. And the high frequency to make the low lot base work. Okay, you need a high frequency. The other way isn't doubling by going up by 1.33. But this one is a slightly more complex version of the grid martingale. You can research that on your own, but that's the introduction martingale strategy. Okay, that's the first thing when it comes to the martingale strategy. What you could do here is that you bought, right? Market is going up, you believe it's gonna buy, you put another buy position. Okay, this one will be back to 1 lot. Since you won, you reset. Okay, then you get did right over there. Then you decide to sell right after losing, and you double it. Then it sells. You hit TP, so you can be switching positions and directions whichever way you want, and you still make money. As long as you keep doubling the lot size every single trade, you will make money. But it's a very dangerous strategy if your capital is limited or if you go with higher lot sizes. Now, the second version of this is what they call the grid martingale. Okay, so there's grid trading and grid martingale. You can look at grid trading. Grid systems make money. Grid martingale also makes money. Grid martingale is slightly more popular than just normal grid systems. Okay, so with a grid system, what you have is basically you draw a grid. Okay, let's say the price was moving. We have the price over there. That's what we have. Okay, so you're gonna put limits 1, 2, 3, 4 limits there. Okay, so we're gonna have a sell there, got a sell there, got a buy there, got a buy there. Basically, what's gonna happen? Say a market comes down, it sells, you start making money. So this is 1 lot. Okay, the simple grid system. There's 2 lots, all right? So the market keeps going down. You start making money. If it goes like that, you've got 2 lots. But let's say the market doesn't go in your favor at that point. It sells you in, then it starts coming back. When it gets there, you're gonna buy 1 lot. Now your position is hedged. Now, if the market keeps continuing going up, basically, you're gonna make 1 lot profit. You understand? 1 lot profit. So basically, you traded 2 lots. Okay, you've got this lot open, it's the loss. You've got that lot open, it's the profit. That lot open, it's the profit. 2 lots profit minus 1 lot, that equals 1 lot profit. That's the simplification of the grid trading system. What could happen in some scenarios is that the market keeps dancing around here, keeps dancing around there. Then you get fucked by fees. But it's very rare for that to happen if you're trading on lower time frames, like the 1 minute time frame, with the right spacing, the right grid spacing. This can work. You can make money from this. Now, I've explained a slightly more complicated version of the grid system in the simplest way, I suppose. Okay. So we're gonna go like this. Okay. I'm gonna have this system. I'm gonna have 4 levels. Okay. Market is moving. Okay. Market goes down. You open 1 lot. Okay. Actually, nah. I won't give you guys this system. You're gonna have to figure it out on your own. I'm a little bit greedy, I won't lie. I still want to make money from that particular system. I'm not yet done cooking with it. Okay. So the next thing that we have is interbroker manipulation. So this is now the realm of arbitrage systems. Interbroker manipulation. The reason why I call it manipulation is because you are manipulating the broker's latency, essentially. Some people could call it latency trading. You can call it whatever you want. It's your trading system, you decide. Okay? So these are the true names. Interbroker manipulation, latency trading, it also falls under the arbitrage systems because they're taking in arbitrage. Arbitrage is basically taking advantage of something. So when it comes to this latency trading, okay, let's say you have Xmas over here. Some people might be thinking this requires you to have some crazy fast internet and having a lot of fucking money to make this work, but you don't. All you need is a fucking VPS, which is less than $100. Some could be more than $100 if you want to take it to a higher level with the brokers that make more money, basically. Okay, the more money the broker has, the harder it is to be able to exploit this. But basically, we have Xness there, we have deriv there. Okay, so we've got gold. Okay, so let's just put a D here for deriv, then we put an X there for Xness. So basically, gold could be at 5,231. Okay, then there, gold is going to be at 5,232. Okay, there's going to be, let's say, at 1535. Okay, the real exchange, okay, so where these guys get their data, the exchange, I'm going to call it EX, is going to be 5,231. So from this is a guaranteed system, by the way. This is, you think that 100% win rate strategies don't exist? This is one of them. Near 100% win rate strategy. If your execution speed is constant and you don't get fucked by slippage, but basically 100% win rate under the good circumstances. This is how the hedge funds trade, how funds trade and make fucking money. This is the basics of what they do. This is not exactly what they do. Okay, if it was exactly what they do, or they did, and it was this freely available on the fucking internet, it would stop fucking working. They kind of do things to make it not work for each other because they optimize, they work on the sub-second level, probably like 0.01 seconds, they open and close the trade. Okay, so what will happen now is this is the real price. Okay, so deriv is quoting the wrong price. So deriv is going to have to correct to this price. So when deriv is going to correct to this price, we know that this price is going to drop down by $1. So we know that possibly at 50.35, this is going to drop by $1 in the next minute. So when we see this situation happening, these are correct, this one is wrong, we're going to go to deriv, then we're going to sell in deriv. This one requires a trading bot. You cannot do this manually. It's fucking impossible. So basically, we sell on deriv at 5,232. When market corrects, 5,231, because deriv is wrong, they're delayed. It would be legal for them to not correct. So they have to correct. They correct, you make $1. That's if you're opening 0.01 lots on gold. If you're opening more lots, you make more money. Simple shit, yeah? Sometimes it's not a discrepancy of $1. It could be a discrepancy of $5. Okay, this could be even at 250. This shit happens sometimes, although extremely rarely. The discrepancy is usually low. It's usually in the sense it would be 31.5 there, and then there it would be 31.2. That's the difference. But you just catching these tiny difference, okay? So it's gonna go up, this one's gonna be higher, you trade on this one, that one is lower, you trade on that one, up until all of this shit is trying to match this. So you are matching the real price, exploiting their latency, making money from these fucking guys. That's interbroker manipulation. You can trade on one broker which is faster than the other one which is slower. So basically, you know what's gonna happen in the future. You're not fucking predicting, okay? You fucking know what's gonna happen. And you think your Forex gurus teach you this, you motherfuckers. When was the last time you saw someone share so much free fucking sauce? Giving you their bullshit strategies, the alligator strategy. You buy when you see this pattern. It's all fucking bullshit. Patterns are astrology for men, you understand? They're like astrology, but for men. That's fucking chart patterns. Fucking bullshit. You can try to convince yourself otherwise, but it has been statistically proven that shit does not work. Okay. Now we are going to go to randomness. Trading with randomness. This is similar to the other system I was telling you before of the buy stop thing, but basically what you try to do is to make money regardless of what the market does. Market goes up, you make money. Market goes down, you make fucking money. Those are the two options that you have. Okay. Another way of doing this, just give you one of the many ways of doing this. You can have an insane risk reward ratio. Let's say it's like that. Okay. It's 1:60. 1:60 risk reward ratio. This is not 1:60 with a stop loss of a lot of pips. This would be the lowest possible stop loss. You set it at the lowest possible stop loss your broker allows. Then you put the highest TP, which can happen within 3 candles, for example. Highest TP possible in 3 candles. Basically, you're gonna have the market moving, okay? Since these are big candles, the market will be moving, stop loss, moving, stop loss, moving, stop loss. But one time it's gonna hit TP, moving, stop losses, hit TP. Basically, you're gonna take 30 stop losses and 1 take profit. After 30 stop losses, 1 take profit, that means that you made 30R after a sample size of maybe 60 trades. So in 60 trades, you make 30R. You're gonna get back 30 times what you risked. There's one way of trading with randomness. There are a lot more ways to trade with randomness, but that is one simple fucking example. Another way of making money with randomness is trading with negative RRs. Okay? This can be used to artificially increase the win rate. This is how some of you niggas get scammed. Okay? This will be 1:3R negative. Okay? 1:3R negative. What's gonna happen is market is moving. Okay? Usually you get stopped out there. But since your R is all the way there, market goes up, it's take profit. This can make certain strategies profitable. Not all of them, very specific strategies. But it's very difficult for a normal human being to trade like this. If you've mastered emotional control to the highest level, you can fucking do this. You can try this. And if you see someone selling you a trading bot like this, you are probably fucking getting scammed. Because they're trying to artificially manipulate the win rate to something like 80 fucking percent. Okay, but you will not make fucking money because of the EV, the expected value. I've talked about this a while ago. This times that might not equal profitability. I'm not saying it doesn't equal profitability in this particular instance, but that's an example. Okay, this can be used to scam you. This can also be used by some of you who are smart enough to figure out how to make the system work to actually make fucking money. If the win rate goes high enough, this is warranted and it will make you fucking money. That's another way of trading with randomness. Now, another thing that you need to look at is correlations and causation. You need to understand the difference between these two things. These shit can be useful or completely fucking useless. Correlations aren't very useful. Causations are extremely useful. What do I mean by correlation versus causation? Here's what we're gonna do, okay? Let's say that if you look at a third world country, in a third world country, you tend to have poor people. Low GDP equals poor people. Third world country equals poor people. That's a causation. Now the correlation comes in. Poor people, there's a correlation with crime. A lot of people that are criminals. But does poverty cause you to commit crime? Not necessarily. It's just a fucking correlation. It tends to happen. It's a pattern that we see, but it's not a cause. Okay. And another correlation: poor people and dirty environments. Is the poverty causing them to dirty the environment? No. It's a fucking correlation. It tends to happen. Now, if you were to trade, let's say that Trump says that he likes sugar. Trump saying he likes sugar could cause sugar to go up. Then Trump saying something like barnacle, and then every time Trump says barnacle, coincidentally, the price of gold goes up. You could use that to trade. You could, but it's not reliable because it's literally just a correlation. It's less frequent than the other thing. Trump announcing tariffs, the price of gold shooting up or down in whatever instance. That is a direct causation. This is a correlation. Him saying barnacle, then gold goes up. Those are fucking coincidences. You cannot rely on this as an edge, but you can rely on causations. So you can look for causations within the fundamental analysis that you can do. This is analyzing things like news. You could also analyze things like salt availability in a particular location. Okay. And then you contrast it to the price of something else. Example, coffee. There's niggas that literally trade coffee. Some of you from Zimbabwe, you guys probably haven't ever looked at a coffee chart, but you can trade fucking coffee. I have clients that trade coffee and they make money from the shit. I'm not saying that they look at the salt causation. I wouldn't spill their strategy like that. Maybe I am. Who knows? Research the correlations and the causalities. Study that shit. That is it for this fucking video. That's enough sauce for you guys. Now I've told you how to fucking trade and how to fucking make money from the financial markets and what strategies to explore and expand upon. By the way, don't try to look for a done for you strategy, okay? Or complete strategy. You need to develop, okay? You need to develop this. You need to develop your own strategy. You need to develop your own version of the strategy, building based on what they have. Okay. You will not find a completely fucking profitable strategy on the internet, but you can develop one based on the shit that you find. You can modify shit you find, but you need to modify shit that is statistically proven, shit that is statistically valid, not just modifying any fucking bullshit you find on the internet.